And we are live.
Good morning.
Good morning. I have my mask.
I do too.
So we started off like this. Got my Colorado mask on. And,
got my polka dot mask on. Should we do this?
But we decided against it. But we definitely were social distancing as much as we could. So, so what do you want to talk about, JP?
Well, I thought maybe we'd start with maybe what's on everybody's mind, at least top line of the financial media. Is the market yesterday, S&P 500 as measured by that, fully recovered from the bear market. So, and it was the shortest recovery in history. So, that brings us back to, was it a V shape? Looks like a swoosh to me when I look at it, but maybe in retrospect, when you look at it on a broader scale, it's going to look like a blip, like a V shape. And
a swoosh, that's a new one for me.
The swoosh, it's not a letter, right? It was VW and then swoosh.
Oh, okay, yeah, that's cool. I like that.
Yeah, so, and I guess we're off to the races again, into reaching new highs. And that creates, for me, like kind of a pause, like, okay, how do we get this thing to the next level? And what does that mean for companies' earnings, valuation, kind of bring it back to fundamentals, okay? So that's maybe one thing we can see how we view the world, and I would love to hear your views also on an intermarket analysis. I think we're seeing also some linkages between markets are non-traditional right now. We're seeing, for example, gold reaching new highs alongside the market, which is usually not traditionally the kind of sinking that we see between these markets. So, anyways, I know I'm throwing a lot of stuff out there, and I don't know if you want to. Pick one and let's see where we go from here.
Wow. No, I mean, well, let's see. Let's start with gold. I mean, my thought with gold was that we had this exponential move and we were due for a pause, which we had. I was on that final bar, mentioned that. Well, actually, no, it wasn't the final bar. It was Real Vision. And I'd mentioned that it was time to maybe just think about a pause. And we kind of did that. But maybe you can pull up gold. And I noticed that the gold stocks bounced really nicely off of after that initial sell-off. So I think that's kind of, I don't see any reason why the long-term trend in gold can't continue to move higher. You can see how it came down and came back up. So that's kind of my thought. The long-term trend is probably higher, but it's probably going to go through some chop in the near term.
But for the average investor, what does that mean? Usually gold is seen as kind of that store of value, of safety, and that's usually the safe asset, right? And now you're seeing the risky assets, the equities, reaching new highs and gold following suits at the same time. So it's telling something about the market psyche right now. So,
yeah, well, to me it's a currency thing and a Fed thing. Because, well, we've seen this quite a bit actually, where the gold price is going higher while the stock market's going higher. And I think that's a lot of that has to do with, really, it's actually very telling because it tells you that what's one of the big things that's driving the market is the Fed and the devaluation of the dollar. So, and that's also telling you that it's not something that's demand driven. It's kind of pushing the market higher with liquidity.
So great. So that you're saying that we have an asset price, the asset prices are going up because of, liquidity and all of those ease of monetary policy. So, which puts against pressure, I think, was one of your views, of our views recently, was that this puts a downward pressure on the dollar, and maybe makes some alternative asset classes looking more attractive from that standpoint, from that scenario, right?
Yeah, it's just very strange because bonds to me are just a protective thing. It's not really a total return play. I guess we could have the long bond rally quite a bit if we really do get 0% interest rates or negative interest rates. And I was thinking from the standpoint of alternative asset classes. It seems to me like commodities at some point in general will probably come back to life, but it doesn't look like it's happening right now. it seems like it's more of in the precious metals.
Yeah, exactly. We're seeing some movement in the softs. I think sugar, cotton have been, doing some serious move. The agricultural products are still a pretty low depressed level. Besides some weather related issues that we've had in the U.S., we're seeing that. So, maybe if we take that a step further into the realm of stocks, right? If the asset prices, as we see the index going up, is driven by just a demand for yield, right? I always do this. I always bring it back to the fundamentals. The question is, what does that mean for stocks and the valuation of actual individual equities, right? And what I'm seeing is it's getting, even though there's fantastic companies, they're definitely not cheap, right? I mean, by most standards.
Right.
So you have to be you have to be cautious as to what is driving the price up, right? If you take, for example, a stock that has run up, let's say 100% since for the past few months, well, you got to see what has been driving that increase in prices, right? And there's two ways. It's either a multiple expansion or it's actual fundamental change into that, right? And depending where that comes from, it's going to tell you different things, right? If for example, let's say we look at revenue, top line, which is all that there is today because our attention is really on that. So which companies are able to grow or at least maintain sales in this environment are the ones that are clearly being valued.
Mm-hmm.
So if you're seeing a ratio price to sales multiple going up, that is telling you that there is expectations from the market that these companies are going to become more profitable in the future. So there is expectations of increased profits into that expectations of prices, which is great. If you're just seeing, for example, the revenue per share being driving that price expansion, then you basically have a company that is just being driven by trailing or actual revenue growth, right? So I think right now it's useful to look at companies and really see what has been driving those companies forward, right? So so that's something that I'm looking at.
All right. Well, see. So recently, we've been having breakouts in companies that are kind of eclectic, just different industries and some of the communication area. And it seems to me like it's getting, like you said, getting narrower and narrower. So that's definitely part of the issue. But there's definitely money being made. I mean, today, I don't know if you have the accounts up, but today, in that prop account, I want to say it was up, and in the dynamic growth, it was up pretty nice today. I mean, Nike broke out, Amazon broke out, so some of the bigger names broke out. Others are struggling, like PayPal are struggling to continue up forward. But yeah, I mean, I think you're still seeing some things move forward. Lowe's moved forward. It slowed down a little bit, but it's still just steadily marching higher. And so I think that's what you have to focus in on is where are the profits, being able to be made. Yeah. So, and I the question is, there's always this question of, do we need to know why? Well, I think it's important to know why. Because I guess that last statement that you said was makes a lot of sense. It's like, we want to know why. Is it actual fundamentals or numbers that you can see, or a multiple expansion? So the multiple expansion part of it is really can be. There's a lot that's rolled up into it. There's market sentiment. There's interest rates. There's what has to do with expectations for the future growth. So there's, so to me that like just that alone is not enough. Like you have to kind of know what's in that multiple expansion number.
It captures everything, right?
And I know
it's
you
the
know that. I'm just saying.
Yeah, it's the entire market
Yeah.
psychology
How much is
around the stock.
How much of it is air versus how much of it is like reality?
Exactly.
You know, and I think there is some reality with some of the companies. You know, it's just there's also a little air added on top of it.
What exactly? So we don't want to load up on air. I guess that's my point. I don't want a portfolio full of hot air.
Yeah.
That gets deflated.
Well, what
when
gets
it's a
you
pin drop.
excited right now? I mean, what investments are you seeing in the last week since we last talked? Well, we've talked soon, you know, more than just over the last week. But what are you seeing that we haven't talked about, or that maybe we haven't recorded on a video that is interesting?
We've been talking a lot recently, if you've been listening to us, about this kind of barbell approach to the market, right? So there's two ends. There's continuing strength and leadership, and the Amazon names, the Apples, Adobe. It's good quality companies that they're definitely the secret's out on these companies. Been out for a decade, right? And we're seeing. Definitely some action on the other end of the spectrum. I wouldn't say deep value by any means, but we are seeing definitely things like, for example, home building. Is a theme that's we played out, but loud and clear in our portfolio. With Lennar, with Lowe's. So whether it's remodeling or new home buildings is now fully recovered also from pre-crisis levels. So we really didn't give up as much as we did, of course, in 2008, 2009. So we recovered very quickly, and at these low rates, interest rate really makes home buying. Hopefully for people who still have a job, of course, there's a lot of challenges there to be getting into a house or upgrading their existing homes. So that theme is there and it's in place, and you're seeing it play out very well in anything like materials providers so you can play that across sectors, and that's what I love when you see a theme that is strong like this, that you can play in various sectors. We talked about diversification in the past. So if you just look at sector, you're like, okay, I've got a company in discretionary, which is home building. I've got one in materials. I've got one in, but then it's the same theme. So if the theme falls apart, you're like, wow, I've got a lot of exposure to the idea of home building, right? Doing well.
The more macro your theme is, the more you could be wrong.
Exactly.
If you load up on it, yeah.
Exactly. So those, we said about the way we look at diversification in various types of companies. Would identify that versus just the traditional sector diversification. But I do love those themes when they work. You can put a lot of things in place and play that into a portfolio.
So that's one of the reasons why I like I think some of the stuff in biotech and the DNA, like in the prop account, about this CRISPR Therapeutics. It's up 8% today. I mean, Nike broke out. It extended today. That account's up 97 bips today. The solar, I think there's some solar stuff happening, and I think what's happening there is that the market is looking for unique and not. Remember when we talked about it? There's like this barbell thing going on versus the post-COVID versus the kind of I'm afraid that COVID's going to expand again. There's that trade-off. Mm-hmm. But then there's this other niche that's just I just want to find growth that's not related to any of this monkey business. And that's the biotech, that's the solar. Those are I think that's where the market is continually trying to find something there, and I think that market is pushing those stocks higher, but it's getting a little dangerous. You got to be careful when that happens, because those stocks can turn around and really rapidly. But you're seeing that, and I noticed that as I was going through and doing my review over the weekend, that it's not that many stocks really. There's not that many stocks that are setting up technically. I mean, and fundamentally, it's hard for you to find. If you look in the deep value bucket, you're not finding a whole lot.
And they're not moving. We nipped at some of those, and they're not our best performer. They're not there yet. They haven't woken up. So we're early on it, and we knew it.
Yeah, exactly. And but then you had these beautiful setups last week and the week before, and Some stocks that Scott Miracle-Gro, I think, is another one that would fall into that category.
Yeah.
Where I think it's kind of not as related to these big themes, because there's a lot of big money that's being thrown at these the kind of the general themes, and I have to say the indexing is just outrageously moving the markets. Like you and I have talked about this, and everybody talks about it, but it is something that you really have to reckon with. If somebody's when institutional investors start hitting that buy and sell button. So I wanted to bring up an interesting article I read that was put out by Fidelity, actually, along this lines. Everybody talks about how indexing is outperforms the market, all that stuff. Fidelity put out a great study where what they did was they said, okay, well, most of those studies were of the S&P 500. And they said, well, what happens if you take the asset managers, the mutual funds in the Morningstar database, and you just eliminate those that are in the bottom stars, star, 1-star and 2-star funds, get rid of them ahead of time, right? A priori, I guess, before you look at the data. And then what if you said, okay, now let's look at those and also eliminate the ones that have extremely high expense ratios. And then let's do it across tons of asset classes, not just on the S&P 500. And if you look at the data, active outperforms in most classes. And they did a daily graph showing a zero line, and when it's above the line, it shows active outperforming. When it's below the line, it's underperforming. And what you'll see is that most of that outperformance happens when the market gets rough. So we've gone through an extended period of time where active it's been hard to beat passive, because we're in this. We've seen this before. Last time we saw this was, of course, .com bubble.
.com, yep.
But in the long run, the data is not as strong as people say. If you just did some basic screens and saying, I'm going to find managers ahead of time that Morningstar evaluates on their simple quantitative score, because that 5-star rating is not a qualitative score, it is a quantitative score beforehand, right? And if you just said, get rid of the ones that are just outrageous expense ratios, according to Fidelity, that's not as robust of a thought process or robust as of data set that you would. So we're really focusing in on large cap, S&P, and that's been the story. And then people have just used that halo effect, basically saying because of that has applied to that one group of 500 stocks, let's go ahead and apply that to everything and index everything. I think that's a false premise.
No, I mean, I agree with that. I have to agree, because that's the fundamental of what we do. But I think what that is the environment that we are in right now. It should be conducive to stock picking and superior selection in this environment. I mean, we need some volatility, some dispersion of returns. That means the difference between the great companies and the not so great company from a fundamental standpoint is should be rewarded right now. So if you have the ability to identify those companies.
But where you really shine, though, is when you have these bad markets. If you look at our performance, where we've really shined is when we've had these crappy markets. By preserving capital and then easing our way in and scaling out as things get frothy. And we'll underperform when you have these rip-roaring markets, but we get a steadier ride. At least that's historically been our performance, and and I think for most investors, that's really what they can handle. You're really not trying to hit the cover off the ball at all times. If you do, you're going to get stuck in some massive declines. So, and that's one of the reasons why. I mean, our goal is to just make a good, reasonable return, building real wealth for our clients. And if you just look at the S&P by itself, I just think it's just the wrong thing, and people are so focused on that. It really is the wrong thing to be looking at. It
is. I mean, you hear like, oh, all you need to know is own Amazon. It's almost a one-stock portfolio, and you would have been right for probably the past 10 years.
Well, we could have put all our money in Amazon.
That's made a lot of wealth for people, and it compound. But there are other companies that will offer those characteristics, and that's again what we're trying to position the portfolio for. Is what are these great growing companies that have something going on for them, and that the market is maybe not rewarding yet to the extent that it should, right? So.
But you've picked some good stocks lately, always. not
thank
always,
you.
but you have. I mean, risk adjusted. I've been just kind of looking at some of the things that you've put into portfolios, and I've been very pleased with them. And I think some of the things that bug me are the ones that should go up and don't go up, like Walgreens. Boots Alliance. I've been on that stock for 2 years.
I know you can't love it enough when you look at the fundamentals, and this is where we can again take that tangent to technical analysis versus fundamental analysis. From a fundamental standpoint, you cannot love this business anymore, but then you realize the market has no appetite for it right now and does not fully understand the business, and that's been it's. Basically, we're not getting crushed on it, but it's not going anywhere. So it's what you would call dead money in the business, right?
Yeah, and then we had some like NVIDIA, up 71%, Viva, Amazon, and we had some that were sleepers for a while, but had everything in place, and they finally broke out, like Dollar General now finally broke out.
Yeah.
And so, I mean, that's another one of those. And some of them just, you just look at them and go, well, that should be moving higher. Like Cisco, for example, had a earnings report issue, but the company longer term is probably a pretty reasonable value, right? It's just we're not right on it right now. I think we're down like 8% or something as of now.
Exactly, and this was a forward-looking, this is a perfect example, right? Forward-looking where the company is well positioned for the right kind of spending going forward, what we need, like investments in communications and hardware. That should really be a nice tailwind for the business. Mm-hmm. But right now, again, earnings, there's been a very rocky earnings season, and the market has been relatively ruthless as far as punishing companies that don't deliver that either top line, bottom line, or guide. I mean, it was all about guidance, right? Because we're looking forward here. The market has discounted most of the bad news here. So we're looking at guidance forward. So that's a good example. Right? That hasn't worked. We started nibbling again, I would say, I'm going to say again, at energy, which has had quite a bit of a rally, both from a commodity standpoint. Oil and gas prices are show some strength, but still as, equities, it's a very challenging environment where investors do not want to commit capital to that sectors. We've seen that, but there's value there, and there's a massive shift. This is where maybe there's a long-term trend there, where the right companies will adapt and adjust to whether it is the shifting focus of energy as an entire sector of the economy. And others will
maybe we should do a
disappear,
technical read real quick on energy. Can you pull it up so I can look at it real fast?
Yep.
Because I think, if you don't mind, I think the energy thing, I know last time I was looking at it from a bottom-up perspective, individual stocks, there was very few stocks that got me excited from both a fundamental and a technical perspective. And I'm wondering when that's going to change. And maybe, it's been a couple weeks since I looked at the charts on that one. I was wondering what that looks like, just because, there's, what are we looking at? Okay, there's a spider.
Yeah, so there's the overall industry, but if you compare that to, what we own, which is ConocoPhillips or...
that's one of the only ones that's...
it is stronger, but still not breaking out from the group.
Mm-hmm. I think that's okay. I think it's okay to have some money there, and of all the companies that are out there, they have the good balance sheet. They have the valuation's reasonable. Yeah. It doesn't look like their dividend's going to blow up on that one.
But if you look at BP, for example, so British Petroleum, which has been lagging, but recently announced that they will basically shut down a lot of their production over the next, we're talking about 20, 30 years. Mm-hmm. But it's a major commitment from one of the major integrated oil companies to really say, okay, hey, we realize the world is changing. We're not going away from fossil fuel anytime soon. However, there is a shift happening, and we want to be part of that. We don't want to extract ourselves out of business, right? So, and then the market, again, not liking necessarily that whole idea. But those are kind of interesting themes.
I want to ask you a little bit about active versus active weight. Like basically, how much do you want to be more concentrated versus not concentrated? Because I've been thinking about that concept, and we're doing some testing on that as well, some simulations on that. But it seems to me like if you're really going to make a difference, I mean, you got to have some level of concentration, right? I mean, it's you don't want to obviously over concentrate, but if you're going to, make a difference, unless otherwise you're going to just wind up being an index fund.
It is. I mean, right now, what's interesting is the way we trade stocks. As you know, we take an initial position, and then if it works, we do add on to it. And so we have an add-on protocol that is very, very strict. And right now, actually, we are more invested than we've ever been, which is great. So the things that are working, we are adding on to it. Now we're almost fully invested. And, just a week ago, we were 20% cash. Now we're, about 7% cash. So we have been increasing our position size to what's been working, and hopefully weeding out the things that are not. And that's basically this idea of, while you want to pile into what's working, and that's how you're going to outperform and not sell too early, we also have to be mindful of the risk, right? So that's always, portfolio construction is this balance between risk management and expected returns in those stocks, and that's always been that exercise. Portfolio construction is the process of putting these two objectives in balance for whatever objective you have. And like you said appropriately, our goal is to provide a superior risk-adjusted return over the long run to our clients. So we're not trying to only focus on returns, right? Which would definitely be a very different portfolio than what we have.
Yeah.
And we also don't want to be too conservative where you cut off your upside. So it's always that balance, which is very dynamic in our case, extremely dynamic, I would say, on a daily basis.
The other element of that portfolio construction is the objectives, of the investor. So, the return requirements, risk tolerance, of the investor. So, with that, but yeah, that portfolio construction is more important. The more it's funny, the more I do quantitative analysis, the more I've come to the conclusion that portfolio construction is more important than security selection. And position sizing, it is. I can actually verifiably show that, and so sometimes we don't want to, it's not a very good story, though. It's not something that people want to hear. That's not the narrative that people want to hear. They want to hear what is the story behind the stock, why should it move higher, I want to be part of that. One prime example is we had a client that called and saw a particular opportunity with some research from a third party and wanted to be a part of that. So I dug into that for the client and put together a basket. But it was interesting because that was all story based. And there, it's okay to do that. But you know what? I found that the story is not as important than the numbers. The story, to me, the numbers are just the narrative is fun, but it's not as important as the numbers.
Yeah, it sells. It's always what I do when I teach it, basically. Said I have a great narrative supported by rigorous
numbers,
right? It has to be.
If you have both, it's even better.
If you have both, it should be the only thing you own is when you have both things. A great story, or at least a good understanding of what's going on, that basically confirms these numbers, that these numbers are not just numbers, that could be somewhat manipulated or misleading. So you said, okay, yeah, there is really something behind that, and that's what we do, hopefully. But that thing is something I just struggle with every day, and you and I, I've heated argument about it, which is this idea of, this narrative that this is a great company and a great story, but the market is just not, is telling us something different. And that's perfectly fine. So we're going to let the market, again, tell us what's working and what's not in the end. Now, we're not at the point where we could say we could trade anything at random profitability, but we certainly try to put the probability on our side by doing things this way.
Yeah, it was, the other part of this is that the overall market is when it's been relatively tame as it has been after we had that big drop. People get lulled into complacency very quickly, and so I think that the big thing is to look at the overall market risks as well, because it doesn't really matter what strategy you have if the overall market is having trouble. I mean, honestly, none of them make money, so it doesn't matter, and that's the beauty about having diversification too in non-stock investments. But as long as if you have a bottom-up approach and you have risk management, you will be scaling yourself out of the market when those conditions exist. So right now, what's actually happening is the list of opportunities is getting smaller, but they're not telling us to just be completely out.
Exactly. It says still own what you own in our case, right? Some of the stuff that has been working, we don't have a sell signals. We have been taking some profits and reallocating to new ideas that we just started discussing. So we've seen that rotation, but right now the market is not giving us sell signals. And if you do that exercise well, right, basically you will have a confirmation from your top-down analysis. Hey, the market is right now, like, I feel like I want to get out. Well, the stock level behavior should confirm that, and you should start seeing some sell or reduce signals in your portfolio. And we've seen that. Usually things should behave properly.
So I heard this scientist on Joe Rogan's podcast. Lawrence, I'm trying to remember Lawrence's last name now. He's a very interesting guy, theoretical physicist. And one of the things I was working out this morning while I was listening, and one of the things he said was that you need to be okay with understanding that things are going to change. And you need to try to prevent your models from having obvious problems, but also understand that things are going to change, that you need to adapt to the changes. And what he was talking about was using some of this genetic information and moving forward with that type of research. And he was talking, and there's this big fear that it could be really dangerous, for humankind and stuff like that. And so he was talking about, yes, but it's like one of the old sayings out there: a ship is very safe if it's just parked in the harbor, but it's not what it's meant to do. It's meant to be out there sailing, right? At some point, you need to get out there and start sailing. And I think that really applies to investing, because I look at a lot of these trend-following managed futures guys that are really old-school types, and they've got a really good long-term record, but they go through so much pain to achieve that objective, because they insist on keeping their models in a way that's that doesn't quite adapt as it should. And they will tell you that we just want large sample size. We want, we're not going to look at any fundamentals at all. We're just going to look at price and all this stuff. And I understand where they're coming from theoretically, but I think that they're missing a certain element that some of the better traders have. That have a little bit more of an understanding about changing as the market's changing, and you don't want to be changing all the time. You want to have but you want to have an idea about when you should change, when you should have modifications. Like there's an overall structure to what you do, but there has to be the parameter of it, how you do it, and the tactics may change. Like there's some things that never change, and what we always strive for is to find those things that don't change and stay with that. That's really what we try to do. But within that, within those things that don't change, there is an element of nuance.
Yeah, definitely. I mean, we don't want to, I guess, trade on
the latest fad.
On noise.
Yeah,
I would call it trading on noise
there
versus what is really information that is actionable and price. I mean, in the end, it has to be priced in. The market has to care about it, which right now, I think something that may be on people's top of mind is like, okay, wow, the market is reaching new highs, yet there's still tremendous amount of hardship in the real economy, you could say, on Main Street, and that kind of what feels like a disconnect. It feels odd to a lot of people, but then you have to. I bring it back, and I might be the one. Like some days, I'm like, wow, this feels kind of bizarre. Like the market is doing great, and investors are doing great, but I'm seeing still, 10 millions of jobs being may never come back. Like we're seeing now, the amount of permanent job loss may be higher than, or at least very high. Well, you got to say, okay, the market is a pricing mechanism, right? So what can we price in that news? Just to really bring it back to a tractable problem. What does that mean? Is that irrational? Is the market irrational or disconnected from Main Street? And when you do that exercise, then you're like, okay, what is there to price? Okay, so what does that mean? How do I bring those parameters, those economic factors into my model and the way I value stocks, and what that means for businesses' earnings in the end, which is what the market does. It discounts future earnings, right? And that gets you usually to a place that is a lot more reasonable and rational, and staying away from more of the hype of the day or things that are maybe irrational, which right now there are certainly some things that are irrational. You look at valuation and you can't, at least I cannot justify owning some of these stocks at these current valuation because I'm not able to make a rational case for them, right? Versus others are like, okay, yeah, it's not cheap. I'm not getting $1 for 50 cents, but I'm getting a fair amount.
I heard a very interesting concept that made a lot of sense to me. If you have different time frames in your thought process, one would be that secular time frame, like what's happening, really long-term demographics and all that, and then then of course would be more the cyclical, and which is in this business cycle, where are we? And then there's the kind of next 6 months to a year, what's tactical within the next year. And I think that's a good way to be thinking about things. And I'm kind of really always thinking that way. It seems to me like where I'm a little bit, I would even say, confused, and it is okay to be confused. But where I do think it's a little confusing is that this whole concept of the cycle. One could argue that we went into a recession, and this is a classical recession, and now we're going into a recovery, like that kind of a thing, right? I think that's kind of becoming the conventional wisdom. I'm not so sure that that's the case. We've talked about this. I think that was an exogenous event, and we're still in the same cycle that we were in before. Even though, yes, technically we're in a recession, a lot of it, honestly, is I mean, let's just be honest. It's self-inflicted, right? I mean, we have to be careful with the COVID, so we basically just shut everything down. I mean, so actually, it's interesting. I pulled up the COVID numbers. When I look at the net rate of change, to me there's a disconnect between what is being said about the pandemic versus the numbers that I'm seeing. So, and I'm going, okay, like comparatively speaking, and I'm not saying that we shouldn't be worried about it. We obviously should be. But I think that we have actually blown it to a proportion that has, where the cost-benefit analysis has actually turned negative. And at some point there will be a realization, and then when that changes, and I think Regeneron today had made an announcement on a cocktail that and we've been on Regeneron for quite a while, as from an investment perspective, and that's been working out pretty well. You can kind of see the handwriting on the wall what the sequence of events are likely to be. Nobody knows for sure, but the sequence of events are likely to be that this whole thing just kind of eases its way down. There's this concern right now that we have since the kids are going back to school and all that, we're really going to find out in a real-time experiment now, because I started thinking about it. It's the number of contacts people have that increase the risk. So we are officially now systematically increasing the number of contact points with COVID.
Exponentially, yeah.
And it is an exponential thing because it's a network effect. So we will know soon, I think in the next less than a month, we will know what we're up against. And I think that's going to have a big impact on what happens in the market. So I think the next 4 weeks is going to be really important.
No, I agree with that. The one piece I disagree with and is that you said the cost benefit, right? And the question is cost. And you talk about lives here, you talk about health and stuff, and it's hard to put a price to that, right? And I think so every life.
I understand that logic, but that's not really what I went.
Yeah, exactly. But I needed to
because there's two different. We're going to get into philosophy now, I guess. Yeah. But there's a philosophy of maximizing the benefit of the whole versus the individual, and and that we will go in circles forever. And in fact, philosophers have gone in circles forever regarding that. So we're not going to get anywhere with that.
We're not.
But if you look at the economics of what's happening right now, and there's no way of knowing, and we shouldn't try to find out what would happen if we just did nothing. Like it's almost like the same thing as global warming. Like in global warming, you don't want to play around with what if we just leave things alone, right? It's like you should do something, right? Because it's like that small percentage chance that it is an issue, or maybe it's big, depending on who you are or who you believe. That's big enough of a problem, right? If you're rational, you should do something, in my opinion, right? So to me, that's a lot like what this COVID is like. It's like you can't do nothing. Right. So, but I think that we will see an easing of this, and it will be the market already showed the first reaction of that. But what I'm concerned about is the damage that was done during this period of time. That we just continually be doing increased damage to our long-term economic well-being by continuing to print money, continuing to do things that are bad for our economy. And the outcome of the election, I don't think who knows. But that, I think the market's going to be digesting all of that stuff. So we just got to be ready for all of that.
Yeah, and I think bottom line for all this is exactly that. There are scenarios that are not the rosy ones that have to be considered, and see what that means to portfolios when you talk about portfolio stress testing. So what happens if that is, right? If there is really, let's say the next 4 weeks, like you said, don't go so well, and they send all the kids back home, and we get back into a semi-lockdown situation, that certainly has a meaningful and material impact that probably will be prized by the economy, by the market. Right now, those are low probability events. The same thing with the elections, right? I mean, there's two distinct outcomes, which right now the market is not necessarily trading on, but I'm seeing that being an increasingly high focus by the market as far as what that could be, because again, all the focus has been on the current recovery and COVID situation.
How's healthcare been doing relative to the market?
Very well, actually. It's one of the leading sectors. Now, if you look inside of that, of course, biotech has been doing very well because of the amount of investment that's going on there, and it's vaccines.
But if you go to the big guys, like the Humanas of the world, the Uniteds of the world.
What exactly? So those are the ones that are still under pressure. I mean, you look, we own Cerner in that space, which is little bit of tangential. It's healthcare information, but the true healthcare system, this thing is still under pressure from that political overhead, maybe versus the pharmas and biotechs that are right now the bright spot in there.
And our current view basically is that the election is more of a sector thing than it is an overall market thing, probably.
Yeah, absolutely. Yeah. So this one is the poster child of something that will fluctuate with with the polls probably and what's going on there,
so this is really cool because you and I are have similar yet different views on all of the political stuff, which is not really important, but it's cool because then we get to hear different viewpoints, and we can
Yeah.
talk rationally together about it and debate things rather than getting hung up on a bunch of emotional conversations. And so, but I really think that that the market may continue to move higher beyond what we expect. And one of the clues to that is that the small cap stocks, they continue to base on a relative basis. The relative strength chart is basing, and then I'm looking at the leadership in revenue companies still moving higher. So there's an appetite out there, and then there's just so much money flowing into the market. I just don't see how the market would turn negative unless, actually, I think if the COVID numbers really skyrocketed, that would be enough. That would be enough to really knock us down, I think.
It could, and I agree with that. I mean, those are, I love to see some action in the smaller end. Like we've been, like I'm thinking about Gibraltar. That's a very small company for us, but it's worked great. We're up 33% in a couple of weeks on that.
Nice.
Definitely when you look at a theme, a sector, we are looking down market, looking at the smaller names, the more pure plays, if you will. And that's, given to opportunities, we might choose the one that these guys look cheaper, right? And if you're right, then you get a little more upside potential. Comes with risk as well. But to your point, what I think is important is to look at what's really happening to the real fundamental of these businesses, right? I was looking, for example, at sales growth, right? We talked about as a driver of companies. Well, that's a very, very difficult thing to associate. Like you said, these growth companies are growing great. That should be where you want to put your money. It's apparently not. It's not that simple. That direct relationship is not. If it was that simple, we probably wouldn't be here talking about it.
It's actually not the historical growth. It's got to be the anticipation.
It's the anticipation growth, and that's where we're trying to look at. Looking at that.
And it's not all of the growth. There's another part of it. There's a subset of those fast sales growth companies that are the winners. It's not all the sales growth, because some of it has to do with sustainability and acceleration and expectation.
Mm-hmm.
So, and then how close are they to being profitable?
Yes.
What the business model looks like. So I think it's not all sales growth, and that's why if you run pure factor tests on growth, most growth figures, you get negative numbers, negative alpha. Because it's looking at historical stuff it's already baked into the cake, so therefore it's going to underperform. So there's more to it than just a historical sales thing. Well, let's wrap this up.
Yeah, let's wrap this up.
What final things do you want to say here? Anything at all that?
I don't know what the takeaway is. I mean, I right now everything is in place for the market to go up. That's how we're positioned. And I'm not going to say caution, but more smart, I would say, about the reasons why we're here and how we go forward, and not just on things just because, right? So, and that goes back to your point of sound stock selection, as well as as proper focus on the market, the overall market. So that's kind of where we are.
Very cool.
Yeah.
Yeah, well, investing is so much fun. I can never be tired of this stuff. So, well, that's all for now. JP, thank you so much, buddy.
Thanks, Louis.
And we'll talk to you later.